stock market is a tool that can either build your wealth or destroy it. I learned some lessons the hard way, so you don't have to. Stick around and find out what these 5 lessons are and thank yourself later. Just a disclaimer for this video, nothing in this video is financial advice. This is for entertainment purposes only. I'm just a guy on YouTube sharing my experience. Ow, what the hell? Ow! I just sat on my foot. Hey guys, how's it going? So in this video, I'm going to tell you about 5 mistakes that people learn the hard way when investing in the stock market. The first one of these, and the one that I suffered from the most, is to not chase. So when I was new at investing, I saw some like penny stocks that were just like shooting up like crazy, and I didn't know any better, and I just went and bought and put like a decent amount in and hardly knew anything about the company. They were always like these biotech companies or whatever, and they would go up like 8% in like the next 2 seconds or something, and I would think, wow, I'm gonna get rich. And I can see that the price is like in pennies, and I'm like, oh wow, if this even becomes $1, I'm gonna become a millionaire and blah blah. It's not gonna happen. Like 99.9% of the time it's not gonna happen. So now what's happened is that in those stocks, in one of them, I'm literally down more than 100% because of the foreign exchange thing. It shows as like 99, but like when I open it, it says profit and loss minus 101 or 102 or 103%. And foreign exchange is like profit of 4%, so it becomes minus 99%. But basically I have like these 3 stocks: Bantech, HCMC, and I think there was one more that I'm just down, like lost all my money in them. Like whatever I put in them is gone pretty much. Like I have like what, like £5 left or something. Basically I'm just leaving them for now, so whenever I need to take out profit, if it's more than like the tax-free amount, I can just take those losses to reduce like my tax liability. That's all I'm using them for now. So yeah, that's a good thing you can do, by the way, if you have like some big losses. Because like, what am I gonna benefit from taking out the £5? You know, like, it's not gonna make a difference. So when you see something just skyrocketing and all this, just wait, just calm down. Everything is being unrealistic most likely. It's all just, don't get emotional and get super greedy and excited. Just wait for it to fizzle out. It'll probably die back down. That's what usually happens. Things shoot up and they go back down. Then you can buy it, and then it can continue on its way up, if it's even a actual good company. And in those cases, they weren't even good companies. They turned out to be like scams pretty much. That's the thing. I didn't even know what I was investing in. I was an idiot. I was new. It was like my 2nd month investing or something like that, and I was like doing pretty well at that time, and I got overconfident and greedy and thought, oh yeah, you know, I'm like a genius, let me do this and that, and yeah, it doesn't work. Second lesson is to diversify. Don't put all your eggs in one basket. Don't put all your money into crypto, or all your money into commodities, all your money into gold, all your money into silver, all your money into oil and gas. If I had to pick one thing to put all my money in, it would probably be tech, because the tech sector is pretty safe. But even then, you shouldn't put all your money in one thing. So make sure you're diversified in different sectors and different industries. So make sure like you have some tech, you have some fast moving consumer goods, you have some energy, you have some transport, travel, defense, whatever, you know, you make sure you're diversified. The best way to measure diversification is usually by a correlation coefficient. So it's like they take 2 equities, for example, and they compare them with each other to see like the correlation coefficient thing. And this correlation coefficient is like a number that shows like how correlated 2 things are. So if something has like a strong positive correlation, that means that they move up together and move down together. If something has a strong negative correlation, then when something moves up, the other one goes down. If they don't really have a correlation, then it's like one thing goes there, the other one it doesn't really have anything to do with the other. So the best diversification is when you have like a negative correlation. So when something goes up, the other one goes down. So that is actually really beneficial during like market crashes. So when there's like a market crash, usually all the tech stuff goes down and stuff like that. So most people are like heavily invested in tech. Even people who just hold ETFs, usually most of it is tech. So when tech goes down, their entire portfolio goes down. They see like a whole bloodbath going on. So for me, whenever it's been like a crash, I've been like still kind of okay, because when tech goes down, commodities go up, or travel goes down, defense goes up, you know, it's like, because I have like a bit of everything, even though it is probably more on the tech side. But that's kind of the thing, because everything is involved in tech now. Like tech is just a really big thing. So it's hard to like fully stay away from tech. But the more unrelated things you can get that are all good investments, the better your diversification will be. The third thing is to manage your risks. This is especially important for risky stocks. And by risky stocks, I don't mean like a random penny stock from China that no one knows about. I'm talking about anything that isn't Google or Microsoft or Apple or PepsiCo or whatever, like these kind of things. Anything else, even like Mercedes, BP, whatever, any other company I consider as riskier. Even if they're not really risky, you definitely do not want to put all your money into one thing. If I had to pick one stock to put all my money into, it would be like Google or Apple or Microsoft, because they are really stable. But even then, you shouldn't. I know people who have lost like millions by putting all their money into one stock that they really believed in, and they really thought that, yeah, this is gonna really, the numbers make sense and everything makes sense and they're doing the right things. You never know. Any company can do anything. And even if the company is good, laws, legislations can come out that can destroy that entire stock, or like mess up a plan, or a project they're working on that everyone's excited about could get cancelled. You do not want to put all your money into one stock. It's very, very important. Like, I cannot stress enough. You'll see a lot of people who'll put all their money into one stock and then triple it and double it and become millionaires overnight. And you'll think, oh my God, wow, I know people like this. And they've lost that money just as quickly as they made it. So in the long run, it doesn't work, because there's only so many times you can get lucky. That is literally like going all in on one number on roulette or something like that. You know, it's in fact even riskier maybe. You have to diversify. And if you don't, you're going to learn the hard way. You might double, triple your money and become a millionaire, and you will lose it if you keep following that same mentality. It's not a sustainable model. Number 4 is sell the news. Buy the rumor, sell the news. In some stocks, for me, one of the cases was like Lucid, for example, or CCIV, which is when I bought it. When the news came out that the merger was true and everything, it like shot up and I tripled my money. I should have sold, because that was like an unreasonable price for it at that time. Even though I believed in the company, I should have probably taken my profit, waited for everything to calm down, and then buy again and hold it long term. So when I bought it around like 11, 14, something like that. $14, 11, 19. I was like averaging, so it was, I think the average was around 19 by the time it like skyrocketed. The price reached like $62 and I still just held, and now the price is like $7. So imagine if I sold and then bought again. Now, even with half the money, I would have more shares and I would have money on the side. And I still suffer from this mistake because I'm just bad at selling. Investing in stocks is all about mentality, and we all need to get our mindset right. Like I still make some mistakes, and you will, and everyone does. I'm just telling you what's the right thing to do. I'm trying to practice what I preach as much as I can. But for me, like, I don't know, I just struggle to take profit because I'm just like, no, it'll go up, it'll go. Because, I don't know, many times I sell and then it continues going up. And then when I don't sell, it goes down. I don't know. It's like someone's just watching my portfolio and making the whole market move against me. But still, the right thing is to sell the news. I'm just telling you. And the last thing in this video that I'm going to talk about is to not time the market. Every time I've timed the market, I'll be sitting waiting for like this crash. Everyone's going to say, oh, inflation, the market will crash, this will happen, that will happen. And then nothing happens. I'm just accumulating cash. Waiting, when do I invest? And then everything starts going up. And I'm like, oh my God, I should have bought it when it was lower. And then I end up buying. And then the market crash happens, which is kind of what happens now, like today. Right now, when the market's crashed, I've been anticipating this crash from a year ago, since ages ago. And I've been like keeping cash, waiting. Not a year ago, like maybe 8 months ago or something like that. And I've been waiting. I've been saying, oh, second half of 2023, there's going to be a crash, there's going to be a crash. And I've been waiting and waiting and waiting. And then I eventually started seeing everything going up. So I put my money in and now we have a crash. So I would have been better off just putting money every month, which by the way, that's another thing. Dollar cost averaging is better than putting all your money on. So like, let's say if you have like $100,000 and you want to invest them in the market, don't put them all like at once. Like today, I'm going to take all my money and put it in the market. No. Like even though you have the money in your bank account, put a little bit this month, a little bit next month, because then you can average with the ups and downs and ups and downs. So some months they might go down, you'll benefit. Some months they might go up, you'll average up. But if you're holding long term, your average price doesn't actually matter that much. I suffer from this disease of caring too much about my average price because like I want the price to look small and all this, but in reality, in the long run, it doesn't really matter because in 10 years, like who cares if you bought it $2 up and $2 down? Like it's not gonna matter. That's if you're holding long term, which you should be. Please like and subscribe and comment your thoughts. If you disagree with something I said, let me know. It's all good, you know, we can discuss it. And subscribe for more content, and I'll see you in the next video.